Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us on another troubling day for the stock market. And on the program tonight, we have Raymond Chan. He'll discuss that fair value for the Australian stock market is actually over 7,000. And his thoughts on shares. Well, we asked the question, is it going to be a correction, or is this a buying opportunity, or is it something a lot worse? And then we have Shamgar, who discusses whether inflation will actually hit 7% by the end of the year and what it actually means for stocks. That's a really important issue. If inflation comes off the boil over the course of the next 3 to 4 months, the stock market will have a different attitude because it'll mean that the fears around interest rates could be brought down a notch or two, and that will be good for stocks. Now, before we go to our first guest, Shane Oliver sent over a really interesting piece, which I'd like to share with you. And he says that share markets have fallen sharply in recent weeks, which we're all aware about, continuing the plunge that started earlier this year due to worries around inflation, monetary tightening, that there's higher interest rates, recession, and geopolitical issues such as the Ukraine war. Now, he says it's still too early to say whether markets have bottomed. And he also says that it clearly is going to have an impact on everyone's superannuation. And he says the key things for investors to bear in mind are that share market pullbacks are actually healthy and very normal in the absence of a recession, a deep one, and long bear market situations. And he thinks this is going to be avoided. He doesn't think a recession is a high chance. He sees it as, I think, 50-50, but he doesn't think it's wise for people to naturally presume a recession's coming, and this bear market that we're seeing in the US necessarily comes here and becomes a real troubling situation for us. And he makes the point that a problem happens when you sell into a falling market, and then when it rebounds, you've actually, lost out twice. You've lost when you've sold out at a low point, and then when it rebounds. So he says, be very, very careful about your attitude right now. Don't be affected by the short-term effects of this correction, which it is for our market, a bear market in the US, but it's a correction here. So just take it in your stride and recognize that there's probably been an over excessive reaction to the prospect of higher interest rates. Rates can go higher, but at the moment, the market is kind of presuming that Jerome Powell, the head of the Fed, and Dr. Phil Lowe here are a pair of knuckleheads who will really muck up raising interest rates and end up with a recession. At this point in time, I'm giving these guys the benefit of the doubt and keeping my fingers crossed that they actually do manage this interest rate rise cycle effectively without getting a recession. Anyway, let's hope that's right. Let's go to our next guest. By the way, I'm on the way home now to Australia from my overseas trip, and I'll be back in the studio on Thursday. Thanks for joining us. And now let's go to our first guest.
An interesting market today, notwithstanding the fact that it's a Monday, plus it's a day before a US public holiday. But let's have a look at the winners and losers. I want to start with the losers because the market finished down 0.6%. And interestingly enough, they're all in the resources column, right? Materials and energy. I guess that tells us something as we get increasing talk about a recession. People are starting to worry about what that might mean for the outlook for commodity prices. But I think it's also a function today a little bit because we are getting towards the end of the year. There are some great profits in terms of the materials companies, the BHPs and the Rios and the Woodsides, and maybe a little bit of profit taking. So BHP down 5%, Woodside, Rio down almost 5%, and Fortescue 8.4%. Then the energy side, Woodside and Santos both off 5%, and then South 32 down 2.4%. There were some other losers as well, but that's what really accounted for today's losses. Let's go to the on the winners side, and this is more representative of perhaps of the sectors that haven't been doing so well and are perhaps a little more defensive in nature. So Transurban's probably the odd one out there. It responded in terms of a better than expected half-yearly distribution. That says, I guess, something about the confidence with which they're looking at their business going forward. But some of the beaten up tech stocks, Xero up 3%. Some of the retailing stocks in JB Hi-Fi up 4%. Wesfarmers also with a good gain of 3%. And then healthcare, CSL up 2.8%. And then finally, most of the banks are also higher. So the stocks that did it pretty tough last week, the last couple of weeks, saw a bit of bottom fishing in those, and people were buying some of the more beaten up stocks and selling in the resources. And I wonder if that's going to continue in the next couple of weeks as we get to that all-important 30th of June on Thursday week. But remember, no leads tonight because no holiday in the United States, and I guess we're going to see a fairly subdued market for the next couple of days. Coming up, Raymond Chan from Morgans joins us. According to my next guest, fair value for the Australian stock market is over 7,000. Joining me now to discuss that, plus to share his thoughts on whether this is a correction and still a buying opportunity, I'm joined by the head of the Asian desk at Morgans, Raymond Chan. Raymond, welcome to the program.
Hi, Paul. Thanks for the invitation.
Oh, great to see you again. Now, I'd like to really put you on the spot here, but we are undergoing a correction, and I think the question many investors have is has the trend changed? Is it we in a bear market in Australia yet, or are we still a market where you buy the dips?
A very good question. The US has entered into the bear market, and the Hong Kong stock market entered the bear market about 1.5 years ago. And us, we're still in a correction territory. We're yet to be in a bear market. By definition, we need the market to go down for 20% before calling it as a bear market. But when we look at the market, with the price action on a daily basis, we wouldn't hold our breath. Sooner or later, we may also enter into a bear market.
So if we're not in a bear market and maybe there's some buy the dip at the moment, where do you see the best opportunities for investors?
Sure. I think we have to go back to the market correction and the bear market and to realize where the opportunity is. The first thing is the stock market correct every few years. So it's no surprise, when I first joined the industry, we have, very good run in the technology sector. And then in early 2000, there's a tech wreck. And of course, we have the GFC, and then, we have the European banking crisis. We have the COVID hit. And now we have, what they call, the central bank induced correction here. In terms of opportunity, I like to stick with quality stocks because one of the things I do look at is, yes, we have seen meaningful correction in growth stocks. However, if we go back to the past 20 years, yes, growth stocks should demand a premium PE than the value stocks. However, despite the correction that we've seen in the growth stocks since pretty much the beginning of the year, growth stocks still trading at quite a high premium to the value stocks. So to get that down to the historical average, we still see some downside risk on the growth stock. That's why, Paul, to answer your question, I can continue to see value stocks. The like of, the Lottery Corporation, MCOR, that, MCOR is specifically the one that I've been talking about on the Switzer TV for a few times. I can still see those stocks are doing well, in the face of a very challenging stock market environment.
Yeah. And are there, so where do the banks sort of fit in that analysis? Because they're not really value stocks. They're certainly not growth stocks. So I guess there's somewhere in between value and growth, I guess. But they've been hit hard, particularly over the last couple of weeks as the market, I guess, suddenly realised that higher interest rates aren't necessarily a good thing for banks. They can actually be a bad thing for banks because of they might lead to higher debts. But where do you sort of see the banks sort of fitting in that, sort of analysis that maybe, the growth stocks have got to come back a bit more still?
Yeah, when we look at the banks, I mean, the first thing, we all have to realize is all the banks are getting very, very cheap funding from, from the Reserve Bank TFF. So at a very low interest rate, that is rolling off. So if we look at all the presentation from the big four bank, they are all talking about they need to repay this money over the next 2 years.
Yep.
So that of course would require them to to look for other fundings for the balance sheet. Yes, and with the banks as an investment, I always think, I guess since about 2 years ago, I really think hard about the banks. The first thing is, I do not want to overweight bank because of all the structural changes in the bank, in the finance sector. But second of all, with the existing bank that we hold, my mentality is I would like to hold for yield. I know, there's some talk out there already, the payout ratio will be cut, that there's issue about the property market, potential downside risk there. There's a lot of talk. However, I still think even with a potential cut in dividend, I think the bank will still pay a pretty good income. And the way I look at it, if the bank can still generate around 5% income per annum, and I would just hold as a part of the portfolio that I don't look for growth. Bank can't grow. That is the reality of life. And how the like of bank generate their earnings, they're cutting down on the cost. Westpac has a big plan talking about cutting down costs big time. And they sort of, on track to achieving that in the last result. That's why the share price bounced back and before today's downfall. In very short term, I certainly see value in bank. And, for those who already hold banks, for yield, if this is the purpose, they should continue to hold on to the banks.
Yeah, so I think what you're saying is that, look, don't necessarily go overweight, but just sort of stay basically market weight. If you're long-term holder, happy with the income, they're not, things aren't going to get that bad. And, by the way, there's a lot of bad talk out there, but the banks are still writing back provisions. So we're a long way from seeing any changes in the income side. Okay, so that's banks now. But overall, your thesis is, and I appreciate the hesitation that we're sort of in this correction and we're getting all these pressures from the United States, and you think growth stocks need to come back a bit. But I read some research from you guys that said that fair value for the Australian market was over 7,000, right? And we're currently, 6.5-ish or 6.6. So, do you want to just explain what you mean by fair value for the Australian market and what you think that means in the medium term for our market?
Absolutely. Our strategists had come up with the fair value. How does he come up with the fair value? It's a combination of factors that include a forward earning estimate. Remember, this forward earning estimate is not just Morgan's, it's the market, it's the whole market.
Right. Okay.
And then, of course, it's the 10-year bond yields and the credit spread, a number of factors. And what happened since the beginning of the year, despite the ASX 200 reached a record, sort of a record high, close to a record high, because the record high was last year. The fair value continued to go downgrade because of the lower earning estimate. However, what happened now is after a series of downgrade lately, especially over the past 2 weeks, we see the fair value, stabling around the 7,100 mark. As of today, of course, it is well below 7,000. The reason why the fair value failed to downgrade further, I have to, explain a little bit further, is because of credit spread. What do I mean by that is everyone know that globally, all the government bond yield are shooting higher. This means people are selling down the government bonds, but this money, for now, they are all going into the corporate bond. So the credit spread, which is the difference between the investment grade bond and the junk bond, are at a level that is not worsening. In fact, it's improving. The money are not leaving the bond market. As a result of the improvement in the credit spread, we see a stabilization of fair value. Yeah. However, the market, if we saw what happened last week, we have a massive sell-off on the back of, the Federal Reserve action. The market overshoot on the downside. That result in, the market being something like at least 450 points below our fair value. For us in a very short term, that create value for the long-term investor. So that's how I see the fair value. The fair value will continue to change. And the biggest change, Paul, I would see is in the upcoming reporting season. That will, in a couple of months' time. But for now, we are happy we're happy with our fair value around 7,100 points. And we think the market in short term is oversold.
Right. So once we get through tax loss selling in June, which we're probably getting towards the end of, and we start rolling into earnings season, and some of the influences maybe from the US settle down a little bit, you're a little more confident in terms of the short to medium term outlook for the market. Is that a fair synopsis, Raymond?
Yeah, it's a fair. If we look at the seasonality as well, the second half of the year tend to be better than the first half. And also, just a quick word on the tax loss selling.
Yeah.
As we know, June is the end of financial year, but also happen with the funds management industry is the funds manager will have to open up their book to show people what are their holdings. That is the reason if there's loser in the portfolio, the funds manager may not want to let the investor know.
Yeah.
So they may just clean out those loser and potentially buy back at the beginning of the financial year. That's why we see the weak stocks tend to perform worse. However, we also look at the seasonality of the tax loss selling. It actually getting earlier and earlier. Instead of wait till the last week or the last day of the financial year, the peak of the tax loss selling actually happened last week. So the middle of June, people tend to position a little bit earlier. Not sure if the same logic will follow for this financial year though.
Well, look, it's a really interesting point, and though I call it tax loss selling, you're absolutely right. That's probably a small part of it. It's more the fund managers, as you say, really clearing out their portfolios has a bigger impact. And as you say, the weaker stocks get weaker, and the stronger stocks, the money flows back in there. So could be an interesting reversal as we move into July. We'll see whether you're right. So we'll put you down for that, and let's see some of those weak stocks have a positive start to July. So thanks for joining us, Raymond. Thanks for joining us on Switzer. Great to have you on the program. Last week, the Reserve Bank Governor implied that inflation might hit 7% by the end of the year. To tell us what he thinks, whether that's going to happen and what that means for stocks, plus some stocks that could benefit from higher interest rates and a couple of takeover targets, I'm joined by Ron Shamgar, the Head of Australian Equities at Tamman Asset Management. Ron, welcome to the program.
Thanks for having me.
Now,
how are you doing?
Now, last week, the Reserve Bank Governor came out and said that inflation perhaps could get to 7% by the end of the year. That was probably a little bit higher than many in the market were talking about, because earlier we'd seen sort of 6%, and the last CPI figure was less than that. Do you think A, 7% is achievable, and B, what's your reaction to that? Has that changed your outlook and the way you're thinking about markets at the moment?
Yeah, definitely. Look, there's no doubt that the outlook for the Australian economy has changed dramatically over the last week. I think, even though our inflation rate in Australia is below 7% at the moment, I think we're seeing the US, inflation numbers sort of hitting 8.6% a couple of weeks ago. And I think there's no doubt that if you look at what's happening in Australia, we've had, minimum wage growth. We've had, essentially an energy crisis. Energy bills are going higher. And I think we're going to see, we stick to a lot of companies, and we see a lot of companies in the market in different industries, and everyone is seeing margin pressure, and they're all looking to put up their prices over the next few months. So I think we haven't seen inflation sort of peak yet in Australia, and I think we're a little bit behind where the US is. So I think it is quite likely that we'll see, inflation go higher. Now, whether it hits 7% or a bit lower, a bit higher, it's anyone's guess. But there's no doubt that central banks, here in Australia, looking at the US, they really sort of have been behind the curve, and they're trying to kind of like front load the rate rises so inflation doesn't get out of control. And in fact, I think the market kind of wants that. And the market is afraid that central banks won't go quickly enough and inflation does get completely out of control. And we've said this for a while, but we believe that the current inflationary issues are not going to be solved purely by raising interest rates. Raising interest rates will reduce consumer spending. It will taper credit growth, which is good. But there are other issues in place. We have an energy crisis around the world. We've got the war in Russia and the sanctions on it. And then we've got the supply chain issues, and then all the COVID zero policies of China, which is not helping with these supply chain problems. And they're not going to be solved by raising rates. So I think central banks will need to adjust their sort of medium-term target range for inflation. But I think they do need to raise rates in the short term just to sort of bring that inflation numbers down. And it will probably take a few months to trickle through the economy. So, rates rise now, but inflation might only start coming down in 3 months from now.
And do you think that we're over the worst in terms of the way the share markets reacted to the news out of the States and higher forecasts in Australia? Or do you sense that there's still, because no one has yet sort of got a handle on whether it's peaked or not, we aren't out of this sort of conundrum yet?
Yeah, look, I mean, I definitely think it's going to continue to be volatile for the next 3 months. I don't think we've seen the bottom yet, but I would say that we're probably a bit closer to the bottom than we are to the top. So, we are cautioning. I mean, I do think that, in terms of telling investors just to be caution and hold more levels of cash until there's a bit more clarity of, how much rates will rise and how quickly economies fall into recession, because there's no doubt that, central banks are essentially putting economies into recession to slow down inflation. I think, if you look at the markets, the Australian market is a little bit different. So we've been insulated for a while this calendar year in terms of our index because we are very heavily resource weighted, but that's starting to get hit now. And also, it's been a lot of sort of small cap and tech stocks being sold off. But now we're seeing the bigger part of the end of the market, especially the big banks and so on, being sold off because I think investors are concerned. There's going to be slower credit growth and higher bad debts. So the banks, although their funding costs improve with higher rates as they can source cheaper funding from deposits, I do think valuations will come down. So we're seeing maybe an adjustment there in terms of valuations.
And one of the strategies that's worked very well for a lot of investors, including both retail and I guess potentially fund managers too, has been a buy the dip strategy over the last many years. Do you think that's changed? Is this still a buy the dip market, or do you think a bit more caution is warranted?
Yeah, the one sort of thing that's different this time, it's always different this time, but if you look back in history over the last sort of since the GFC, we've had essentially central banks bailing out the share markets or bailing out an economy that is slowing down. What we have here is the exact opposite. We've got economies that are booming. Everyone's got a job. Job participation rate is at record high here. And the central banks are actually trying to raise rates and to cool down the economy. So I don't see how central banks can actually protect investors here. And this is why we're a little bit cautious. I think that, like I said, the market is discounting everything that's going to happen over the next sort of 3 to 6 months. So obviously, when they announce we hit a recession, markets will be rallying, and that will be the bottom. The question is, well, when will that be? That's really the key here. So I don't think central banks are going to bail out us this time.
Okay, let's go to sort of look at sort of how you're playing it with some different stocks and different parts of the market. Now, one of the things is obviously not every company is a loser out of higher interest rates. So obviously most do because of cost of borrowing goes up and it potentially slows consumer demand and all sorts of things. But some companies actually win. So who are the companies that can benefit from higher interest rates?
Yeah, sure. So, I mean, there's actually a few companies that we looked at, and they're clear beneficiaries from higher rates. These are companies that essentially hold large amounts of money on behalf of their clients, and they get to earn or to keep that interest income from that. Now, obviously, over the last few years, with interest rates being zero, they haven't earned any money on that. But with rates going higher, they're quite sensitive to their bottom line. So probably the number one beneficiary, and it's actually has performed and held up really well recently, is a Computershare. So they're the share registry business. Everyone knows them. They've got about a $25 billion float or cash that they hold on behalf of their clients with them, and essentially they get to keep that interest rate. Now, they've highlighted to the market that they get for every 1% rate rise, it's about a 26 cents EPS in terms of US dollars benefit to their bottom line. So that's quite material. That's you're looking at about 25% accretion on the current consensus forecast. So just to give you an idea, if they raise rates by 2%, say here and in the US, that's an additional $500 million US of income before tax for Computershare. So I think we've seen that stock hold up quite well. They're probably trading on about 17 times PE next year, and they pay a dividend. So maybe that's a bit of a safe haven stock.
They would have been,
if you could say that in this market.
They probably would have been quite pleased with the dot plot last week that showed that the governors of, or at least the members of the Federal Open Market Committee had changed their forecast from about 1.9 to, I think it was 3.4% in the space of 3 months. So in terms of the Fed fund rates at the end of the year. So that would have been good. Are there any small caps? Computershares, I guess, is a big cap stock. Are there any small caps that come to mind, perhaps in different industries, that you look at in that vein?
Yeah, there's a couple of stocks that we own, and I mean, one that you guys know well, and I spoke about on the previous shows, is EML Payments. So they're a payments company. They've obviously been sold off aggressively for a number of operational issues, and also they've been sort of caught up in that tech sell-off. But they also hold about $2 billion of client funds, and they get to keep that interest rate essentially. So they will benefit as well. Roughly every 1% rate rise across sort of Australia, Europe, and the US will benefit them about $15 million of EBIT. And that's pretty material considering they'll make about 55 mil EBITDA this year. So they're also a beneficiary from that. But putting aside, they had some operational issues in the business, which is why they've been sold off quite aggressively recently. The other one that we like, and is also a beneficiary, is a life insurance business called Clearview Wealth. They're also a $500 million business. They've got about a $350 million sort of a float that they hold on behalf of their policy holders, and they get to keep the interest on that. So if the interest rates in Australia go up by, say, 2%, that's an additional $6 million of income compared to their profit this year, which will be 25 mil NPAT. So quite material for their profitability. And they're actually also under a strategic review. Their largest shareholder, Crescent Private Equity, is looking to exit. And it's been going on for a while, but we think there might be something happening in the next few weeks, and hopefully they'll get taken over.
Another thing you were talking about it to me off camera was around some of the takeover targets. And I guess a lot of companies have been absolutely smashed in some of the selling. Are there any companies you'd like to sort of float there, suggest as sort of companies that share prices have really been knocked down, but have a great underlying business and must be sort of become at least on the radar of private equity and others?
Yeah, so there's a couple. The first one is Link Administration. So they've been under a takeover offer from a Canadian listed software company called Dye & Durham. It's essentially an offer that was worth $5.50 in cash to Link shareholders. I mean, obviously with the shares trading where they are today at $3.30, the market essentially doesn't believe that the offer will go ahead. There's a few issues for the offer. There's ACCC concerns of Dye & Durham owning the 45% PEXA shareholding, the conveyancing digital platform in Australia. together with their other conveyancing software that they offer, that they will be able to have influence on pricing in the market. And then there's other sort of, it's a very highly levered financing package for the acquisition. They're sourcing $3.5 billion of debt for this deal. And there's risk that that might come apart in this market environment. And so essentially, if you look at the deal, essentially being priced by the market not to go ahead. But if you look at Link, it has sort of three distinct parts to it. You've got its PEXA holding, which is PEXA is a listed company, so that the current holding is worth about $1 billion. And then it's got its fund administration business, which is really profitable. And it had several offers from other companies at $1.5 billion as of recently. So we know these two parts of the business are worth $2.5 billion. Now the current market cap of the business is 1.8, and if you add the debt, you're looking at about $2.5 billion enterprise value. So that leaves you essentially zero value to the corporate markets and registry business that makes about somewhere between $70 to $90 million of EBITDA a year, and is actually, like Computershare, a beneficiary of rising interest rates. So we think that probably there's no longer any upside priced into the stock to the takeover. And I think there's value starting to emerge, and it's probably trading on, if you exclude the PEXA holding, then it's trading on about 8 times PE for FY23 earnings, and it also pays a 4% dividend yield. So we think that's an interesting one and worth a look.
Mm-hmm. Yep. So it's some of the past type.
The other one. Yeah, that's correct. Yep. And then the other one that's worth a look, and it's actually held up pretty well, and they're having an investor day next week, is Tabcorp. So, they recently demerged its lottery business, and the Tabcorp standalone is just a pure wagering and media business. The current enterprise value is around $2.2 billion, and it doesn't have much debt. It makes about maybe $400 million of EBITDA per annum. Now, this financial year has been a tough year for them, obviously with lockdown impacting the retail network. But I think if you look at that business, just a year ago, it received private equity offers of about $4 billion at the time. Significantly higher than the current share price. Now, obviously, valuations have changed, but I still think it's a valuable business. And what's interesting is that the final dividend this year in August is going to benefit from 5 months of earnings from the lottery business. So they should be paying investors about a 6 cents fully franked dividend at the August results. And I think that will provide a really nice downside protection for the business. Now, they're currently bidding, or the one of 2 final bidders for the Western Australian tab business. It's up for sale. And that would be accretive for them, but they'll also obviously need to borrow money to acquire that. And they also, the Victorian wagering license is up for renewal in 2 years. So I think, it'll be interesting to see what happens here, but I think there's a good chance that the stock re-rates as we go into the August-September dividend. And, it's a possible takeover target, and it seemed to have held up quite well in this environment.
Okay, well, thank you for sharing those ideas around both Tabcorp and Link, and also the commentary about stocks that could benefit from higher interest rates. That was Ron Shamgar, the head of Australian equities at Tamman Asset Management.
And that's the show for today. Let's just hope that the worst case scenario is avoided and the markets eventually start to climb higher. I was surprised if it happens this week. We need some really good news, and we might just have to watch the economic data flow over the next few weeks before we see a turnaround in this pretty negative sentiment. If you want to know more, go to switzerreport.com.au. Thanks for joining us. See you on Thursday.